Good evening and welcome to the Australian Stock Market Show. Now, the All Ordinaries Index has closed up over 0.5% last week, and in doing so broke through to a new all-time high yet again. So is a rise to 9,500 points now on the cards in October? Well, stay tuned as we'll discuss our thoughts on that shortly. We'll also take a look at the Australian market, and for our main topic in tonight's show, we get into term deposits versus dividend stocks. Which is the best investment right now? First up, we'll share our hot stock tip for the week, so sit back and relax. Again, tonight is jam-packed as we have loads of emails to answer. We'll also take your phone calls and give you the answers to some of the important questions around the market. Tonight we're excited to share our thoughts on some great stocks like New Hope Corporation, Wesfarmers, Karoon Energy, the All Ordinaries Index and more, so strap yourself in for a great show as we'll get into those soon. I'm Dale Gillam, the Chief Analyst here at Wealth Within, and I'm your host for tonight, and joining me are two of our team of highly experienced and professional traders, Janine Cox and Philip Tortevsky, and together we have over 60 years experience trading the markets. Wealth Within is Australia's most trusted stock market educators. Good evening, team. How are we?
Wonderful, thanks. Had a lovely weekend at the zoo.
You were zooing.
It was very interesting. I just never realised the size of what comes out the other end of a rhinoceros.
I'm not even going to ask that. I had some friends that went to the AFL Grand Final. That was a bit like a zoo, according to them.
Yes. Well, no, I just had a barbecue cooked. Nice and simple.
A little bit normal.
Food. Yeah.
You weren't looking at the rear of an animal.
No.
Okay.
No, thanks.
All right, well, tonight, as mentioned, we get into the Australian market. But first up, let's take a look at this week's hot stock tip. Phil, what have you got for us tonight?
All right, so tonight the hot stock tip is Perseus Mining, stock ticker code PRU. So let's get straight into it. On your screen right now is themarketindex.com, and Perseus Mining is a miner, but it is a gold mining company that operates 3 mines in West Africa. Edelken, if that's a name, in Ghana, and Siswingi and Yaouri in Cote d'Ivoire.
Wow.
How's that? How's my
Sounds
African?
impressive.
Pretty good, right? So it's got some good performance as well. This one here, you can see a 1-year return of positive 55%. It is outperforming the sector on a 1-year basis by 52%, and also outperforming the ASX 200 by 39%. So really leading the charge there in terms of movement. It's got a market cap of over $3.5 billion, ranked within the top 150, ranked 141. So a stock, in the 200, most common to plenty of people here, Perseus Mining, but the important stuff, as always, is what is on the chart. So let's move to that right now. And I want to keep things simple and go to the monthly chart, but with Perseus Mining, obviously what I've marked here are a few levels and markers, and most notably I've got these arrows through here, and this is just to, I guess, signify the cycle or the stage that this stock is in, because we've shown time and time again on this show, stocks, they do go through cycles, they go through stages, and the earlier you can identify where you are you in contraction, are you in expansion, are you in consolidation, it really helps identifying that, and then overlaying the right type of trading strategy to run with that move, basically. So going back to the chart, if we can, obviously we've got this real long contraction period from August 2011, a textbook accumulation that was near all-time lows during 2015 all the way up to 2019, and now we're in expansion, which is a very nice thing, especially if you're looking to trade the uptrend, trade long. And what I've also marked is a secondary rectangle box through here, and this is, as stocks move up through these trends, they do rise, pause, and it's nice when you see higher bases and higher accumulations, which we have seen around $1.55, 56 with this one going back from 2020 up to 2023. We've had really nice expansion over the last couple of months. And what's quite interesting now is we have broken to the highest level in June 2024 with this overriding uptrend, which is a positive sign. But as stocks break through to new levels or highs as they're running in an uptrend, they do have the tendency to fall back within trend. What's exciting about this one is the fact that it is holding. It's been 3 months since it's broken through to that new high above the April 2023 high, and we're starting to see consolidation as these bars are inside the bar made in July 2024. So as the stock continues on, if it can consolidate further, obviously the more it consolidates, there is going to be a breakout. Now, if that breakout is to the upside, you're going to see some volatile movement or quick movement to the upside, but just be careful at around $3. I see the next short-term level of resistance. So right now, it's obviously in a long-term uptrend. It's all about your strategy and how you're going to eke out the most out of this play.
What do you reckon, Janine?
Well, it looks interesting, and I just think the personality of this stock looks like it's changed from the way that it was. If you go back to the chart and have a look here, we can see that it would sort of really stretch itself out, whereas we've seen much more consolidation, and that's more or less like a spring that's contracted, ready to expand. So look, perhaps it will not even spend a lot of time going sideways and keep going up, and could end up doing something like this as time goes on.
Yeah, and hence the strategy is the most important thing right now.
Well, I agree with both of you. Well, that is it for our weekly hot stock tip. Now, shortly, we're going to get into our topic for the night, but before we do, right now is your opportunity to get involved in the show and have your questions answered. Remember, we are receiving your questions, so text us now on 0423959846. Now, while you do that, tonight we'll give you our thoughts on the Australian market, so let's get into it.
On your screen right now is a chart of the All Ordinaries Index. Now, you're probably looking at my chart and thinking, what has Janine got on there? There's lots of lines and information there, and you might be trying to make sense of it. Well, I'm just going to do that for you. First of all, you can see that this is the 87 crash down here on the left-hand side. I might just bring that over a bit so we can just see what's going on. I just wanted to go back in time so that we can have a look at where the market might be going in future, because what we say is that history gives us a path to the future. It tells us what's probable to occur. Now, this high here is actually 200. There was a 200% gain from the peak if you bought shares in the peak in 87 and you just held them there, you would have made 200%, but have a look at how long it took you to do it. 87 all the way to 2007. That's a long time to be sitting there holding on to that. If we look at what happened and how long it took the market to actually go through to a new high, it was actually 124 months until this period here, where it actually had been consolidating and then peaked in April 1998. We had the Asia crisis around that time. So the market was very volatile. We'll just expand that up for you so you can see it. The market spent quite a bit of time going sideways in that period. If we look at how far the market actually traded up, it was about 50% from where it actually started to break through and started to move on to this next high. So just keep that level in, that percentage in mind. So 200% to the next high, significant high being the GFC, this sideways consolidation in 2002. And then it was 137% from the peak here around the time of the Asia crisis, where it peaked out to 137%. Now, why am I telling you that? As I said, if we come forward, we can always learn something about what could happen in the future. So remember that 124 months, we count forward from the GFC low, 124 months. And we've actually come up with this period around COVID, somewhere around there, it actually broke through that high. But further than that, we see the same sort of consolidation that occurred above that GFC high. So we've got this same sort of pattern that occurred back down here in the 90s is now occurring here. And we've had this break away from that level. Now, I'm not suggesting that the market's just going to go sideways from here. We've seen the miners, we haven't even had the growth that we're expecting from that part of the market yet. The financials have still got more to go. I'm not expecting our market to do exactly what it did in terms of the range to the GFC high this time, but let's just say, let's propose, what if it could do half, right? Because I have a target in my analysis around 14,000 as a absolute top target. Let's just say it could do half that. Well, where would it be if it actually stopped at my first target, short-term target around 9,000 points, my next target around 10,000? It would have actually grown 30% from the GFC high to make that 9,000 points. 50% to the 10,000 point market. See, these numbers are sort of, the 50% is similar to what we looked at in the chart before. 30% is less than 50, but it's still within that range. It could peak anywhere in here in the short to medium term. But note how on the previous chart, half of that 197 is 100, to the same level from this recent peak here, it's 70%, right? If we go back, we had 136, let's say 140, that's about half. So some of the numbers in the stock market repeat. You get halves of things, you get doubles of things, of numbers. You have to just watch for the signs. I've counted from the GFC high forward, we're expecting a peak in the market in 2026, but it could be 2027. So the same distance that we had back here from the 87 peak to the GFC high was 238 months. So we could see a peak later than what we've initially expected. It could be anywhere between 2026 and sometime in 2027. And our market could end up going to around 14,000 points. That's what I'm expecting now based on just this analysis here. But there's obviously a lot more to this than just what I've shown you now, but I thought I'd share something because I know there's a lot of you out there who are thinking that you might like to do some technical analysis and do a course. It's really important that you do it now because the next part of that growth phase is coming and you really want to be well prepared.
All right, well, thanks for that, Janine. Well, that is it for our thoughts on the All Ordinaries Index, or Janine's thoughts on the All Ordinaries Index anyway. But before we get into our first email, remember to get your questions answered live on air. You will need to text into the show. Now, you can also send your questions to info@wealthwithin.com.au and we'll answer them in next week's show. Now, let's get into our first question. How important is a resistance level? Well, Dan is asking, will NHC hit resistance at $5.90? Now I'm going to go to you, Phil.
Yeah, interesting question. It might, but to me, the overriding thing is, what are you going to do after that? Really, at the end of the day, it's we've seen stocks move up and back through resistance and support, but at the end of the day, the real money's made on the trading strategy from those levels. It's just one piece of the puzzle. So,
It's funny, great question. As people say, do you think this stock's going to get to X? I go, yeah, might one day.
Yeah.
So what are you going to do in the meantime, and what are you going to do when it gets there?
Yes.
So is he asking that, do you think, because he wants to sell at that point? I mean, is that the likely theory?
We don't know, because he hasn't given us much of a question there, because every man, woman, dog and child, even the cat, actually knows support and resistance levels. And so they mean not a lot. Unless you've got the strategy around it, which I think is what you were actually saying, isn't it?
Yes, absolutely.
It's like, what makes a support level a support level? What makes a resistance level a resistance level? But also, what strength does it have? Is it a minor resistance or support, or is it a really strong support or resistance? And then what's your strategy around it? Because I know we've discussed in shows gone past that not one of us has ever taken a buy or sell signal on a support or resistance level.
Look, some of those levels just might be a short term, where it pulls back for a week or two and then it keeps going. That's what you're really talking about.
But that's where I say we don't understand the question. So could it go to that level? Yeah, no problems.
Yeah.
Could. When is another question. And what are you going to do is another question. And what are you going to do when it hits that level is another question. So all of those are different questions. So the answer is, yeah, it could, mate. So we don't know. But do you want to have a quick look at the chart anyway?
We could, yeah. We've marked it up on the chart. So if we just go quickly and have a look there for you, we've got the level $5.90 there as resistance. Now, looking at the monthly chart, to me, I don't necessarily see too much resistance right there. If I was to be applying this, I would think somewhere more above these lines where the stock found, a real serious bounce from this level, and also back in December 2022. That would be the more significant levels of resistance. And right now, you could even apply some short-term resistance on the chart somewhere through here where the stock is currently positioned. So again, it's, to answer that question, could it get there? It might, but at the end of the day, it's what are you going to do about that, and how are you going to trade that? Because the support and resistance, as Dale and Janine mentioned, they're just speed humps to let you know where a stock may get to, but it's the strategy at the end of the day.
Yeah, definitely. Absolutely, definitely. Well, anyway, Robert, who is asking us about gaps, he writes, what are your thoughts on gaps and how should they be interpreted with regards to technical analysis? Now I'm going to talk to you, Janine, about gaps, because you talk about them a lot.
Yeah, I do. Look, it's a small part of the analysis. It's not a major part of what you need to know, but it does flag that there is a potential for the gap to be filled. So if a stock gaps down and then later makes a low and then moves back up, there's an opportunity or potential for the stock to move to that level, but it doesn't mean it will. And the thing you have to understand is that if the stock trades on overseas markets, there are going to be a lot more gaps on the chart, and it may not fill all of those gaps at all ever. So that's something to bear in mind.
Can I ask you a question then? Do you have a trading strategy around gaps, or you just notice them and you notice what's happened?
It's an observation. It's like you've got a number of things that you tick off in your analysis, and it means that, okay, are there any gaps? Well, maybe it adds an element of risk
So it's
to
not
the
a
equation.
strategy as such, and that's sort of what you're saying. How does it relate to technical analysis? And the other thing is understand it's there and why it's happened. I think is like, well, what happened? Did they do an announcement? Did they do something else?
Or sometimes it's a market-driven one. When a market bounces off a low, sometimes you get a whole lot of stocks bouncing off their lows, and so you might get a gap across the market. If it's a market-driven one, it might be even less likely for them to come back and fill those.
Okay, so in level of performance, not high importance?
It's low.
Yep, there you go. There's your answer. Well, next is Max, who writes, I used to hold Chalice Mining and sold out prior to the collapse. I kept it on my watch list and it looks like it's on a way back. Do you agree? I'm going to go to you, Phil.
All right, so let's go and have a look. For you on the screen is the chart of Chalice Mining. Now, I want to bring up the monthly chart, and the reason I say that is because this stock has been falling for such a long time. Trying to identify significant reversal points on a shorter term time frame is a very, very risky proposition. Given the fall has been since the all-time high, November 21, we're talking 3 to 4 years. You really want to see that reversal happen on the bigger timeframes to know that, hey, this might be something in it. And look, we are potentially starting to see some of that unfold, but right now there is no real confirmation. Obviously, when stocks do fall, the first thing you want to see is a slowdown of that acceleration, which we have seen through here. And this could, in one sense, be an argument that the stock is starting to find its base and accumulate. It's come back and tested the low in February 24, in August 24. It's had a really strong month in September. With a high close, and now we're in October, obviously the first day just started. But what I would like to see to really give me confidence that we're going to continue this bullish momentum is a break of the May 24 high. That's the first thing, and there's no, give on that scenario happening. If the stock were to break down and take out the September low, then I would be waiting for another opportunity for price to confirm that it does want to reverse and go high, because that will probably lend itself to tell me it wants to go lower. So first port of call is a break of that May 24 high, and then from there you see how the stock unfolds. A higher base would even be even better.
Well, can I ask you a question? I mean, obviously when we get questions like this, it's often because they've traded it, made some good money, and then they expect it to do the same thing again, like Z1P, like Afterpay, like A2 Milk, and the list goes on of these stocks that went vertical, and then people go, oh, can I get in it now, thinking it's going to do the same thing again? Is this stock likely to do the same thing again?
Well, you oftentimes see on those initial runs, they're either driven by euphoria, if it's a new stock like that happened through this one on April 20. Now, I don't know the exact fundamentals behind this one, but oftentimes you'll see an increase, or the company growing increase in earnings, and then they see that collapse, and the opposite situation has happened. And the company might not be recovering or producing the way it was back in the past. So to expect it to come back to those prices in the same manner, I'm with you. I think things need to line up for it to get back to that point. But just trading price action alone and watching it itself, I mean, there's nothing wrong with following that volatility and getting in on that trade. But yeah, look, the fundamentals need to line up if you're thinking for it to break back through to the all-time high, or the company needs to be showing movement forward to warrant high prices.
Well, good answer, Phil. Now we've got a text. This one's from Gavin, who is asking, can you take a look at Linus? He says, I entered at $6.80 last week for medium term, and he's asking for our thoughts. You want to have a chat about Linus, Janine?
Yeah, this is a stock that we're actually really interested in. Just the consolidation that we've seen to the downside is so interesting. It's often a setup that can provide false triggers as well, so you've just got to be alert to that. It has actually given false triggers along the way, but it's actually really nice if you look at the chart to see that the trend appears to has changed and is now moving in the upward direction, so that's a really positive sign for this one. On the monthly chart, 2 nice strong bars up. That's a great sign. Look, I can see this stock moving higher over time. It's just had a bit of a acceleration last week, so maybe go up for another week or so and then slow down temporarily before it then moves up again.
It's looking really nice, isn't it? So you got any thoughts, Phil?
Yeah, no, I totally agree with Jen. Obviously curling up really nicely. It's found this bit of support or accumulation, and just zooming out big picture, it is coming off a really strong basing pattern near the all-time lows, and we really like to see this with stocks, probably spending more time falling than it is on this rise, but it's only fallen less than half, so that's a very positive sign. Bit of expansion here. If we get another higher base, then I think it could be turning the corner long term.
Well, there you go. That's the team's thought on it, but that is our take on Lynas Rare Earths. Now we give you all this great knowledge and content for free, so now is your time to support us and smash that like button, and also remember to subscribe to the channel. Doing this will help others find our videos. Now, with interest rates potentially peaking and market volatility rising, choosing the right investment vehicle to earn income is more important than ever right now. Now, should you keep your money in the bank earning interest through term deposits, or is it time to earn your income from the market with dividends? Making the wrong call can cost you greatly in the long run, so let's get straight into it. What must people consider when looking at term deposits versus dividend? It's a really great question. I'm going to go to you, Janine, on this one.
Yes, exactly. And look, I think one of the most important things would actually be the market, believe it or not. People don't often think about it when they're putting money in a term deposit, to look at the stock market. So if the stock market is in a boom, why would you want to put your money in a term deposit? It's about having your money ready to invest in stocks. But if the market is in a correction, then sure, put your money into some term deposits. But the other thing that really irks me, Dale, is how the financial planning industry, and I feel sorry for some financial advisors because their clients are probably saying, I don't want to put all my money in term deposits, but the model says that they need to put their clients in term deposits once they get to a certain age, or cash-like products.
Yeah,
and more of, they might have 80% of their money in cash-like products. Now, when people get to a certain age, the reality is you use less money. You spend less once you hit a certain age, whether it be like 70 or 80. So therefore, why would you not have it in shares and just leave the problem to your children? Because they're going to be inheriting that money, or the opportunity, I should say.
Your children have been a problem for you all their lives, so make a problem for them. I like that idea. Now, depending on where you are in your life, it dictates which option really makes more sense for you. I'm totally agreeing with Janine. What do you reckon, Phil?
Well, Janine said it perfectly, and really it comes down to that. Obviously, the later on in life you are, you want to be taking less risk. But at the end of the day, it all comes down to what the market's doing. Because as you said,
your choice. What
yeah,
risk
regardless of age. I mean, if the market's booming as it is now, why wouldn't you want to be in the better performing investment vehicle? It's really as simple as that.
Yeah, and I know what Janine's talking about, because we saw that a lot during the GFC. A lot of people stuck in investments that they didn't really want to be into, and just because that's what the financial planners had to do. They had to put them in a pigeonhole, and that doesn't suit everybody. But anyway, now if you want to take a look at this from 9 News, which shows the RBA forecast predictions for interest rates over the next couple of years, the RBA's forecast period on monetary policy stretched until mid-2026, when it has assumed interest rates will have dropped to 3.8%. So if the RBA forecast is correct, what's the play moving forward? Now, term deposits or dividends? I'm going to go back to you again on this one, Janine.
Look, I mean, if the RBA is correct, then, clearly the option is not going to be to go to term deposits. If the cash rate is dropping, people are going to want to exit that, and that will actually fuel the stock market further. So, I'm just watching and waiting for the RBA to see that decision. But at the same time, it's a bit of a conflict for me, because I'm thinking, I know where we are in the cycle, so they shouldn't, shouldn't really technically go the other way on that basis, but they may do that. So, but I'm expecting, based on history, I've gone back and studied this over time, so I'm expecting at some point, eventually into the peak, they will be increasing that cash rate rather than dropping it to try to slow things down. Eventually that will happen. And then, of course, when the peak happens, it'll go the other way.
I know where the interest rate peaks, the best thing to invest in terms of a cash product, not a term deposit, it's actually bonds, and lock in a long-term bond, because obviously you can get the capital appreciation out of that bond.
But then you have to understand that as well.
Correct.
So that's really important. There were a lot of people, like you said, in the GFC that got put into different products, or didn't get put into the ones that they wanted. But then there were people who didn't understand what they were investing in either.
Well, that's true too. Anyway, so the economic landscape is important, but what does history tell us about what performs better? Now we're going to take a look at this chart, which shows the difference of investing $100,000 in a term deposit versus the top 200 ASX shares from 1979 to 2018. When you show it in a charts, it's eye-opening, it really is. Now, how about you explain it to everybody, Phil?
Yeah, it is very eye-opening, and that's considering, we're talking about a time period that includes the 87 crash, the 2000 crash, the 07 crash as well. So keep that in mind when you do look at this chart. But on your screen right now is the chart we're talking about, and it's just basically a comparison of the investing in Australian stocks versus investing in term deposits. And, using a nominal figure of $100,000, what this horizontal line in red represents is that $100,000 invested in a bank deposit, which obviously is not going to rise or fall.
Stays at $100,000.
Stays the same at $100,000, right? But the red histogram shows you the value of the interest earning component throughout time. And obviously, as you can see, 80s and 90s interest rates went up to that double-digit percent and obviously fell away. So the earning capacity became lower and lower. Now, contrast that to investing the same $100,000 in the share market. The line here, not the histogram, is basically the capital appreciation of doing that, so the value of your shares. From 1980 to 2018, whatever it is, you're looking at a $100,000 investment is up to that $1.3 million worth of value. And measure that to the blue histogram, which basically shows the dividend return. And you can see the vast difference in the dividend return, which is constantly rising. It's annual income of about $50,000, $60,000 by the end of it, versus what you're getting, leaving it in the term deposit. And historically, the stock market is, whichever way you want to cut it, the strongest performing asset class of the lot.
So over time, because the value of your capital's rising, obviously
Correct.
The value of your dividends is rising, whereas the capital's fixed with a term deposit, and therefore over time, as fluctuations, you're really you're beholden to that cash rate, and potentially because the target rate's between 2 and 3% over time, you're only going to get maybe a couple of percent above that if you're lucky.
Well, I mean, obviously this is not adjusted for inflation, but it just shows the power, doesn't it? That being in the stock market, you're going to be beating inflation, where if you're not in stock market and you're just in term deposits, inflation's going to eat you up.
Well, the next couple of years, we're going to see a huge acceleration in the stock market based on history, and so therefore it's going to be complete contrast to term deposits. We have to think about what a term deposit actually is. It's money going into a bank that other people are using to put their money into the stock market to get the returns that were in blue.
Well, as I say in my first book, How to Beat the Managed Funds by 20%, if you're only getting one part of if you either get dividend and capital gain, if you're not getting both, somebody else is getting one of those.
Yeah.
And that's what you're talking about there anyway. But okay, it's stock time. Now we've put together some of our best income stocks right now. Now, Janine, I'm going to ask you to take it away. So these are the best income stocks now, or the highest income earning ones. Please explain what we're looking at.
These are the best income stocks based on reliability, because at the end of the day, when you're comparing income stocks versus term deposits, you want reliable income, right? It's one thing chasing the highest income earning stock, but then they cut the dividend or the share price drops quite a bit, which you can see with the more liquid type stocks. But what we are going to show you are the most reliable income earning dividend stocks, which, guess what, you're also going to get that capital appreciation. So first up, we have Commonwealth Bank. Now, pays a 3.6% yield, which is, I guess,
it's really low. It's below the average.
Yes,
right
but
now,
then you've got to throw in franking as well.
Yeah, that's right. And the stock has grown in value, but generally people expect something around 4.5% return from a share. But look, Commonwealth Bank, because when you see dividends get as low as what they did recently with Commonwealth Bank, the yields, the share price is more likely to come back. The PE ratio was quite high as well, which we're seeing right now. But it's probably only a temporary move, given where Commonwealth Bank is at the moment. So it's hit my target pretty much perfectly. I think I had 142. It's come back from that, but we've got another target around 150. So could see Commonwealth Bank edge up to that in the next few months.
But look at the capital gain you've got out of that stock, and obviously the dividend yield at 3.6. is today's dividend yield. So if you bought it 2-3 years ago, your dividend yield could be 5 or 6%.
Yes.
Based on your buy price. So it's looking at obviously that sort of thing in there. But I mean, this stock's been fantastic in terms of capital gain as well. Whereas, again, put your 100 grand in the Commonwealth Bank and come back in 40 years' time, what would you have? A lot of money. A lot of money.
And I mean, even if we just go back to the chart real quick and go to I'll zoom it out to the yearly perspective, just so you can see year on year the volatility that you do see. And I mean, since 1991, really, apart from 2008, which, well, it was the biggest financial crisis, to date. So that volatility was expected. But since then, really, you do see generally more often than not, or 70-80% of the time, you're making capital appreciation as well and holding it for the long term. You're definitely considering if you've bought it any time after 1997 or even after, at the even if you bought it at the peak in 2007, you'd still be making your income and be in front on the capital appreciation. So it's really powerful
you know
to see.
what? When a stock falls 60%, which is what Commonbank did, bank stocks fell around that degree in the GFC. Nobody's going to hold a stock that's falling 60% in value just to get a dividend.
What do you mean nobody?
Some people don't.
Truckloads of people
I'm
did.
just saying that to give it a
Good, you want to wind me up. I don't know how many people do we met that just held all their stocks all the way through it.
Still do, yeah.
And still do. We told them they were crazy, but hey, what do we know?
So what Janine's talking about is the adding the extra spice on top of actually being able to get in and out of the market. And when you can do that, throw over the dividend and get in at those
just for
best
those
times.
major corrections, even if you're a long-term buy and holder and you've got a good strategy over the monthly chart and being able to get out when the major corrections come, that's
it's vital. You have to be. Like I constantly say, buy and hold is dead. Anybody that's doing it is doing themselves a disservice. It used to work in the 60s, 70s and 80s.
Well, it works while the market's going up beautifully.
It doesn't work. It's
but
not going to work
the market cuts that by 50% every time it has these major corrections.
And we're going to have another crash, as you said earlier. The peak's going to be 2026, 2027, and we're going to have another big crash, and anybody's buying and holding now will get slammed in it, and then the cycle will repeat again. Another stock?
Just because something might work doesn't mean it's the best approach, right?
Well, that's
all right,
true too.
Westpac I really like. Now, Westpac's actually done beautifully. It's having a bit of a pullback at the moment, which I'd expect. Now, we had that lovely person ask about gaps. What was the person's name again? You remember? Spot? Okay.
I will find it for you.
The fairies will tell us. Okay. Robert. Okay. So when the stocks correct and we have gaps on charts, on weekly charts, on a stock like a bank, most likely it's going to come back and fill that, okay? But it doesn't mean it's going to keep falling. It might just come back to that level and then turn around and start moving back up again. But Westpac looks unbelievable, looks amazing. It's done incredibly well.
Any targets to the upside, or would you be getting involved at these levels?
Let's just go back to the monthly chart. I'd wait for the pullback and if you're not in it now, I would be looking at another opportunity to get into it once it's had this pullback. So we've still got 20% to the all-time high. To me, that's saying there's another opportunity in there.
Yeah, to me, it's all about how these move. I mean, we spoke a little bit about it last week. It's about how these moves unfold, whether they're extending, really becoming that blow-off type move, which speaks to that euphoric type of rise, which generally is not that sustainable. You do see markets come off from that. And, we did see that kind of happen through the February 2020 period where it was moving quite uniformly, rising up.
Well, it didn't make much, did it? Look, in the time that after this, where you're pointing to, it had a good gain after the correction, but in the COVID correction, but then it just went sideways and didn't make anything for quite a while.
Yes, but considering we had this really strong blow-off in February 21, you saw it get extended, and the point is that, once you start to see that, generally you're going to see a bit of a pullback. But right now, we saw a really strong rise. This was really strong because it held, didn't really pull back, and now we're getting, again, this really strong expansion. So I'll tend to agree. I think the safer trade right now, if you haven't already picked it up, you would have had a few opportunities back in December 23 and potentially another one in May, June 24. If you haven't got in yet, I would think the way this move is showing itself, you're probably going to get a better opportunity soon.
I just think that the point you raised before about going back and having a look at history really is important because if you look back here, this is pre-COVID. Now, if I expand the chart up, it hasn't done much in all that time from COVID,
Yeah.
It's 13% up, but it's actually only 5% up from where it was in COVID. Now, how many years is that now for?
Yes.
And how many billions of dollars does it make?
So there you go. So look, that's why I still think there's a lot to go with our bank shares.
All right, let's get into the next one.
All right, the next one is Wesfarmers. Now, this is the market darling at the moment. It's done incredibly well. We've had lots of, accelerations, but a big consolidation towards the bottom, not as much as, say, a Westpac. It's done better than Westpac to get through its high relatively quickly. And it just looks fantastic, but we could see a little bit more consolidation before it starts moving up. Now, because we're in, blue sky territory, as you can see, there's the whole history of Wesfarmers there. The yield is so low. And look, with a growth stock, you've got to accept a lower yield. That's just a reality of it. But eventually, there'll be a bit of a correction on it and we'll start to see that yield come up again. But I don't think that too many people are worried about this for yield right now.
Why not?
Because it's done so well over the last year or so.
Well, you never know, because people, they chase yield regardless of what the stock price is doing, isn't it?
To me, that's nuts. It's like a balancing act, though, isn't it? To look at.
Well, does it have to be? To me, it's quite an easy equation. Buy what goes up, sell what goes down. Simple. Whereas people hold stocks falling away just because it's got a dividend yield that they like, which is just wrong.
Which is okay if it's just a short-term correction, but if it turns into a major one, which is what we're good for, to listen to us, because we'll help you to work out when those are. But it's really important to have your own rules so that you can actually identify the stocks when they have these major corrections and potentially could be coming into a 60% fall, so they can get out before that and then look to get back in again after the dust settled.
But realistically, 9 times out of 10 people won't sell.
That's true.
We just know that. They just won't sell. Even though we tell them to sell, they still won't sell. They can ring up and they send us emails and texts and we tell them it's going to go down and they still don't sell. So we see that all the time. So as you said earlier, what happened before is going to happen again. So
it's even more important with low cap stocks.
It is.
Because low cap stocks will take off. They're usually later to take off, but they go absolutely ballistic. In the remember what happened pre-GFC?
Well, and especially if your strategy is purely income. I mean, you're really going to need to know you're investing in good, strong companies that are going to, be reliable and give you that dividend year on year. They're not going to come out of the woodworks one year and produce negative earnings or something crazy. But
so we finished with Wesfarmers?
Yes, we have. Moving on.
We like it. There's upside there still. That's basically the message with Wesfarmers, but short-term downside.
Yes, because the volatility has changed. I mean, you look through just the bars through here, obviously it's quite uniform. And then as we get past the COVID period, everything starts to get way more volatile and there's some serious expansion. So I would say the better opportunity is around the corner.
Okay, now we're going to talk about my favourite stock according to you guys.
Yeah. Well, you know what? It's starting to make its way back this one. It's a little bit interesting right now. I wouldn't hate on it too much.
I'm going to go to my grave and you're going to put on my tombstone, Dale loves Telstra.
You used to call it DOG.
I used to call it DOG.
Yeah, I know. And look, it's still that at the moment, but look, that will change. So let's just have a look at these highs here. Short term.
Almost 5% yield.
Yeah, we can see these highs at around 410, and there's another one just here around 405. The stock's really got to get through those to start moving back up. Once it does that, it's sort of going to be in a more medium-term run, possibly, could go up for 12 months or so from there once it gets going.
Yes, but what's real interesting with this one, if we just go to zoom out on the monthly and the whole data, it's really found a significant low around that $2.73 mark. You've seen it, tested in 2010, again in 2018, and now 2020.
You know what's funny? If that wasn't Telstra, you'd think that was a bull, wouldn't you?
It would look very interesting, wouldn't it? You'd think, okay, we've come out of huge contraction, we've tested lows.
Yeah.
How jaded we've become.
But
like that.
yes.
Some people will never invest in Telstra. They just say, look, we don't want Telstra.
But some people only have Telstra. Because it was like that, between the early, in that sort of 2000s when it was just going down and down and down. People had Combank and Telstra in their portfolio. I don't know how many seminars that I did where I said to people, who only owns Telstra and Commonwealth Bank, and half three-quarters of the people put their hand up.
Wow, that's amazing, isn't it?
No, it's like because they got Commonwealth Bank on the float and they bought Telstra on the float, and that's all they had because they trusted it.
Well, it's maybe a good lesson. You never fall in love with
one good stock and one dog
but
stock.
Never
but
hate
anyway.
one. Yes, because they can turn around. You never know, which is
know.
the exact point. But with Telstra, obviously it is, as Janine said, holding around that $3 mark. It's really, if I apply a horizontal line, gravitating towards that $3.90 up and down. So right now it's really got to find its feet and, as we say, break out into trend, which you're going to really see through that clean price action.
So you've got a long-term view, good dividend, go for it.
Go for it, sure.
Yep.
Why not?
All right, that's the next one.
All right, Woolies. Now, there's been a lot of controversy about Woolworths and Coles lately. Now, I know that there's a really sensitive issue about this whole price gouging sort of thing. And look, it is good that we have regulators who are looking at this, but to me, what's frustrated me over time is we we actually sacrifice Australian companies for competition always. Like, it seems to be that we're just losing these things to overseas companies all the time. Now, okay, they own 60% of the market, or they've got 60% of the market share, the two of them. That's a lot less than what it was some time ago. I think they should be happy with that sort of model or balance, in my view. But I think the bigger issue is that what the supermarkets have wanted to do for a long time is have no brands recognition. So they just have the home, the Woolworths brand products, and then you can't choose Australian companies that supply to the supermarkets. It's not like if I love particular Aussie companies, I can't choose them anymore.
Can we have a look at the chart?
But that's what's happening in the chart. I think that the ACCC is at them. It's holding the share price back. We're not going to see much relief in this in the short term until there's some pressure off in the media about this whole issue. That's my view.
Okay, well, what do you think, Phil?
Look, that's
you got a soapbox you want to get on?
No. I'll just stick to the chart. I think Janine said it all. But I mean, she's speaking, some real facts here, because the chart is really struggling since making that all-time high in July 21. Obviously there could be an argument that we've come into quite an important level in the short to medium term, or medium to long term, being this $32.50 level. You've seen it test as support back in October 22 and May 24, but prices are going lower generally. So although it's coming back to test it, it's not really giving you that series of higher bases. So really right now, anything around these levels at 32, 34, and it speaks to the point about that guy that called in or emailed in the other previously about support and resistance. It's one thing to identify that the stock is at a level where it has bounced in the past, but then what's the strategy? And right now for this one, it's got to be short-term plays off this low, otherwise until the big picture changes.
Right. So let's talk about something exciting that'll get Janine's blood
But there are
going.
opportunities, I
Rio.
think, in
Let's
Woolies.
look at the Rio.
Rio.
Wow, what's happened in the last 2 weeks? Crazy.
I mean, this drives me nuts, actually, when it has the entire reversal off that bottom. It's not a proper reversal. There's no sort of rhyme or reason here, we could say. Other than the big funds have all of a sudden decided, yep, we're going to get into this area of the market, and they start digging in.
Well, it's funny because,
China. It's China
yes,
question.
That too. And, when you look through, I mean, we show the RRG charts sometimes on this show, and you see the cycle of money going through the system. And you see materials were the worst performing sector so far this year. Now they're...
Well, they were heading towards that, recovery, weren't they? Well, no, they were at the bottom section, weren't they, when we looked at it last and coming across. So
right, you've got 20 seconds left on this stock.
20 seconds,
oh
gosh, we could talk much longer than that, couldn't we? But
anyway,
at the moment, after that huge rise that occurred last week off that low, we've seen a bit of a reversal, and I'd expect a bit more of that. Actually, off that, because look, when's the last time it made this sort of a range? October 22. It's still not the same sort of degree of what we saw last week. So if we go from the open to the close, it was 15%. I mean, that's just showing me that the impact of the AI trading and what's going on out there in our marketplace. And we don't have there's a lot of international brokers now in our marketplace that are contributing to that. We've got huge resistance across here at the moment. I think, Rio still has to get through all of that. And if you're looking to buy, there'll be better opportunities coming up.
All right, let's go to BHP. You've got 3 stocks and got 3 minutes, so go.
BHP, 4.6% yield, quite a nice yield given, the stock is trading near or at all-time highs, $44. So, and I believe that is fully franked too, this one. Don't quote me on that. But speaking to what's happened with Rio, BHP, same thing. A really, really strong week in the last week popped out. Now, to me, what this means or what it speaks to is the stock saying, hey, watch me now. Now's the time to be watching and seeing what happens from here. Because it's shown its first hand. Obviously, there's been real buying in here. But is this strong buying? Or is this just a quick, flash in the pan type move on speculation? So right now, it's beautiful that we're in this situation because we get to know the answer to what comes next. And that is once we see the reaction from this particular move right here, and you're going to get plenty of opportunities. If this buying this week is really strong institutional buying being supported, then you're going to get a second, third, fourth opportunity. Because
what about false triggers?
Well, that's basically what I'm trying to get at. You'll know if it is serious buying. The second, third, and fourth opportunity will present itself because institutions aren't buying for a week or two. If it is a false trigger, as you're saying, if it is a flash in the pan move, then you're going to see price action follow that with a move down not too long after, and not really giving you those the things you want to see at significant reversal. So it's important time right now to be watching
All
this
right,
one.
BHP, let's move it fast.
All right. TCL, now this is a really interesting stock. It's consolidated over the long term. Ugly in terms of the formation, I'd have to say. Sorry to the CEO there, but looking at the horizontal line across here, there's still significant resistance there. If you're short-term trader, you might be able to make some upside to that. But I think if you're medium to long term, it's better to wait for all of that mess to be cleared up and for the stock to break through it. But at the same time, the yield's 4.8%. It's not a bad yield. So, but look, you just have to manage the downside. If it goes below that low in June, then you would not be holding on to that thing for dividends.
Yeah, it's clear line in the sand stuff.
Yeah.
As long as it's going sideways, it's nice to collect the dividend.
Nice
But yeah,
dividend, though.
yeah.
4.8, it's
Okay.
a bit above the market average.
All right, last stock.
All right, last we have...
We've got a little extra one that we've
this
sneaked
is a
in,
little
haven't
extra,
we?
yes. I've snuck it in, and it's just to show that we have reliable income, and then we have something like Macmillan, which is one of the higher income producing companies at the moment. So they're producing an income of about 9.97 or 9.7 yield. So let's just go to the chart real quick, and you'll see with stocks like this that sometimes do produce the higher yield and are in the less lower cap type stocks. Look at the volatility. So it's one thing trying to earn an income, but then thinking about I need to sleep at night with this level of volatility. How easy is that to do?
Oh, yes.
So
You can
it's-
lose your income over a few weeks. Yeah.
Exactly. So it's probably best to go with the more reliable stuff. It was just to show the difference in what you're getting.
Well, it's nice having a bonus for our YouTube people, because normally you save all those really cool bonuses for your trading, our trading...
Talking Wealth.
Talking Wealth
Well, we've got
members.
special stuff
Yeah.
for them too.
We've got very special stuff for them
Yes.
too. You sure?
Oh yes, stocks that they're going to want to watch.
Cool. Well, thanks for that team. Really good advice and great stocks from that point of view. Now stay with us, as we'll be right back after this short break. This week on Talking Wealth, Belinda Clementson shares how diverse perspectives are shaking up the status quo for the better.
If organizations want to innovate, then they need a lot of inputs. And so if all of the inputs look the same way and think the same way and have the same lived experience, you're not getting a lot of diversity of thought there, and it's going to be harder to innovate.
Feeling like your expenses keep sneaking up on you? Let's talk expense creep with Jackie Clark.
You earn a little bit more, you spend a bit more, you buy the next bottle of wine, you go on an extra holiday, you might get a new car. It just goes on and on until you put a stop to it. You can start making some pretty significant inroads to what your savings and investment plan might look like, but you have to make a choice.
Trump or Harris, Dana Samuelson discusses the future of the US economy.
This election could create some real havoc here. I suspect that the U.S. economy, is going to weaken a bit further. It's just how much and how fast is the real question.
Get your free 7-day trial now to watch this and more.
Only on Talking Wealth.
Well, that amazing content you just saw is going live this Thursday on Talking Wealth. Now, moving on, if you want to talk about a stock or ask a question, pick up your phone right now and give us a text on 0423 959846. That's 0423 959846. Now, whilst we wait for your text, let's get into our next email. Andrew is asking about the future prospect of Karoon Energy. Now, looking at the monthly chart and price action, the stock looks to be sitting at a significant level. I don't own the stock, but it's on my watch list. I'm going to go to you, Phil. You're the expert on Karoon Energy, aren't you?
Am I? All right, I guess so. Let's go to the chart and have a look for you. He mentioned he hasn't bought this, right?
Correct.
That's a good sign because right now the stock is falling, coming out of this high in October 2023 and resembling all the things that you want to see in a stock moving down, but not in terms of a reversal just yet, because we're getting that series of higher lows and higher highs, presenting that the stock is likely to fall further. Obviously, last month it closed, below the previous month's low, and we're starting off that track during October. It's only been one day, but right now the question is, where is it likely to fall? We did mention a significant level on the chart. Now, if I just bring up the horizontal line through here, it does appear that there is obviously coming into the previous support in June 2022, and a few levels through here where the stock has bounced in the past. If I zoom that out for you, you can see that. But right now it's again that question or that case of, okay, we're at support, fine, tick. But what do you want to see right now from here to confirm that this is going to be a reversal? And they're two very different things. And on top of that is what kind of strategy you're going to enact to get the best risk-reward scenario for you to take that trade to make it worthwhile. So 3 things really to consider here. Right now we're at stage 1. We're still identifying whether that low's in place. So great that you're identifying it could potentially be a support level, but I need to see more both on the weekly chart and the monthly chart in terms of confirming that and then
yeah, because you've got lower lows and lower highs. So
Yeah.
given you've got that progression going down,
Yeah.
therefore it could continue to make those on the way down.
Yeah, and we've only had 1 or 2 weeks up, and that nowhere near signifies, the end of a move,
And
particularly.
there's such small ranges too on the bars.
Especially with what you've seen in this 6th of September, how strong that move down is, and we've seen 3-4 weeks of an attempt to get higher, and it's not even closed less than half of that move there alone. So you need to see a lot more.
So I think probably the thing that we talk about a lot with our students and the traders we're teaching is, if a stock's falling, you need to assume it's going to continue to do that until it doesn't.
Yeah.
But when do you know and it doesn't fall anymore, when it stopped falling? That's what you're saying, Phil.
Correct.
That's where we've got to put more ticks on the box. So at the moment, keep it on your watch list because it could be interesting moving forward, but just make sure it stopped falling before you start to get in the stock. That's really what Phil's saying. We now got a text from Paula who is asking thoughts on VYS. Paula's saying, I'm currently watching to buy. Will this level hold a buying opportunity? And can an upwards run be expected? And she's going short to medium term. So what do you reckon, Phil?
VYS, okay, well, it's very interesting that we are looking at this stock, and we just spoke about this exact scenario a second ago with Westpac, in the fact that when stocks do move up, it's important to see how they're doing it. Are they doing it uniformly with the moving back to the gradient of things, higher highs, higher lows, or are we getting really strong blow-offs, Janine?
Yeah, well, you've got one, look at it.
And right now, this speaks euphoric type of move.
Would you be buying it right now?
No, this is generally where you see a lot of the, I guess, what's the word I'm trying, I don't want to, not amateurs, but
punters.
A lot of punters getting.
Well, there's lots of words for it. Some we can't actually say on air.
Well, yes, but punters is the right word right now. But no strategy, no skill, trying to chase the market and buy the.
We're not saying anything about Paula because she may actually have some knowledge to
Yeah,
put
we
some
don't know.
strategies
That's the
around
point.
it.
Yes, but just from what we've seen in the market, or speak for myself, when you look at these kinds of moves, if we go back to the chart, these really serious blow-offs are more often than not, if I had to bet, met with a move down. I mean, we saw it with Drone Shield when it got to the end of its euphoric run. It fell away quite sharply, and you see it time and time again. If we were looking at this, say, back through this period through December 16, where you're getting the bases, higher highs, higher lows, then I'd say, okay, but even if we marry it through to here, that kind of started to become that expansive type move, which is what you're seeing here on a smaller scale, and we saw that reversal back to trend or back to gradient. Look at these bars through here and the size that it increases. It's very, very obvious it's really expanding, and that speaks to what you see generally at the end, not at the start. So I think it's not a case of buying right now, definitely. If you have some kind of strategy, really short term, maybe.
She's saying short to medium term, that have to be short term.
Not medium term.
Definitely not medium term.
But I mean, some stocks, they go from 49 cents to $5. It has happened where you've seen a lot of these small stocks just accelerate. They get up to $1 at least, and then they keep going.
Yeah, but if you look at that run, there's a certain momentum, how momentum unfolds in stages. And this is its last stages
It's
right
in vertical.
now. It's in its last stage of that. So that's where short term, and it could be weeks, could be months, but it's not going to be years.
Yeah.
Definitely not going to be years. So before it peaks and has a big fall, which is what Phil's actually saying. So right now it's about being careful. I think that's what Phil's saying, Paula. If you're going to get into it, be careful. Make sure you've got a good entry into it. Make sure you've got a solid stop loss underneath it and take that. But anyway, thanks for that, Phil. Now, our next email question is from Ben, and he'd like, we said, would be great to get your thoughts on the recent surge in share price for BHP and other iron ore miners. BHP's current share price has exceeded my entry point, and would love to get your thoughts on where you think the stock could be heading. Ideally, I'd like to see a pullback off this recent rise, but appreciate this could keep climbing. I'm going to go to you, Janine, because this is your favourite stock?
Well, I think we've sort of covered all of that in the discussion we
Right,
had.
you miss out now, so you're not going to answer it anymore.
But I really liked the question,
Oh,
though.
yeah, okay,
I
we're
have to
gonna
give
answer it.
praise for that, because the fact that the stock rose so strongly, it's like reassessing. Have I got enough upside? You know, is the risk reward making sense now? And I just give you a thumbs up for that, you know, whole thinking. In terms of what they've got to the upside from here, I just want to look at BHP, because one of the things we didn't do is look at, well, how far has it got to go to the high? There's still about 13% to the all-time high. But as we said, just wait for the bit of consolidation. If you think that there's not enough room for the upside, then you just make your own decision.
So what's driving? Because he's asking about the iron ore miners. So it's BHP, it's Rio, it's FMG.
Sector driven. It's commodity driven by China. You know, making decisions to stimulate the economy. So because of that, they're then looking at iron ore as obviously a play. And BHP and Rio are the stocks to be in if that's going to continue to be driven.
Okay, so wait for a pullback? Or
Well, look, I mean, some people who are more medium term, if you're going to be in it over the next couple of years, they might just decide to get into it and then set a stop loss on it.
Yep.
But if you want to be a bit, you know, more cautious and manage your risk better, then it's about waiting for that pullback and then looking for the entry
so
above
you're
it.
saying Ben should wait for a pullback?
That's the safer option, yes.
Okay, so there you go. So you've answered it. Now, Janine, wait for a pullback, Ben, and then jump in on it, because Janine loves BHP moving forward. Now, we've got a text from Anne who's asking, I was stopped out of S32 taking a loss. I'm looking to re-enter. I'm tempted to jump in before a buy signal has presented itself. I suspect Janine will say, be patient. Thoughts, Anne?
Good
Janine's
one, Anne.
going, well, I know exactly what Janine's going to say. If you don't have rules, don't do it.
And I wonder if you might be a little bit of a cowgirl trader there, because we do find some occasionally. So good for you if you are. So S32.
Is it good?
Is it good?
I think it's great. I mean, I've worked with some that are amazing traders, women traders, and
Yeah, correct, but they're not necessarily cowgirls.
yes, there's quite a few that I've worked with over the years who are. You'd be surprised. I think maybe they're closet
Closet cowgirls.
Wow.
Okay, I'm not
and they
getting
come
into
out
that
when
at
they
all.
study with us. It all comes out.
Yippee-yi-yi.
Okay, so if we go and look at South 32, we can see there that nice rise. And yes, you're right, Anne, it's about being patient. So right now, it's had its first rise up. There's still this resistance here, which is what really stopped the stock in the first place. You know, it really struggled to get through this range here. There's a band there, and it really didn't stay above that for too long, which is what looks like it could be happening now. It may actually dip below that range again. I'd just be waiting to see if that happens. It's got to show support, in my book, above this range. Otherwise,
So would you jump in now without a buy roll?
Nope. Simple
That was
answer.
pretty simple, wasn't it? What about you, Phil?
Oh no, yes, and it really just speaks to, you know, being the psychological aspect of doing things like this.
Well, it's FOMO to me.
Yes,
And I think Anne's suffering for a little bit of FOMO.
Well, to me, this is a little bit sector driven as well, because we've seen the mining stocks make a move, and this is the same sort of range that we've seen, you know, if we look at that rise that we've seen with BHP and Rio.
but I mean, which is a great point. But aside from it being, you know, event driven, if you want to call it that, it's at the end of the day, once you get into this stock without no rules, it's really going to affect your psychology, because you're going to be sitting there thinking, oh, what do I do now?
What do I do now?
Because you weren't, you know, solid on the entry. You went in on a situation where you're probably not backtested or anything like that, or it's not triggered what you want to see. So you're already behind the 8 ball psychologically.
Smart.
And that's the point, you know, you really don't want to be
I
playing
find that
game.
some people, they get to module 2 in our course and they really want to, you know, buy, and it's about that patience, isn't it? And they start to see that when they get to module 3, why that's so important.
Absolutely. All wise words there, so I'm with you. I love S32, Anne, but I'm with the guys at this one. Anyway, for our last email, Vic Ramjeet writes, I've been buying shares on the Indian Nifty 50 for a while, and I wanted to start trading in the Australian market. What is the best platform available? Also, what's your predictions regarding Pilbara Minerals on a 1-year time frame? I don't know, who wants to handle this one? Do you want to
Yeah,
go,
sure.
Phil?
Yeah, I can do it. I mean, Pilbara Minerals obviously was our hot stock tip, so you can rewind the show back and see what we said on there. That was, you know,
Oh, you're
Well,
not even
it's
going to go
quite
back.
detailed.
Phil's hot stock tip anyway.
Yes,
yeah.
my hot stock tip. But in terms of a broker or platforms, there are quite a few, and it really comes down to what type of what you're trying to do with it. Obviously, if you're trading stocks medium to long term, or what kind of exposure you want. Because I mean, if you want direct share exposure, you have to go a certain way. If you're going to try trade through a derivative or get that exposure through the share market, then there are other options. So do you want safety? Do you want it to be regulated? There are all these things. I would say start off with the major ones, and then go through. The internet is a great source to troll through. I'm not going to name names. Obviously, CommSec is the biggest, but I mean, just go through the internet.
Yeah, but you've got to look at that, because I know there are ones that are on your app. There are other ones that offer commission-free brokerage and all that sort of stuff. And to me, and I know Janine, I've been saying this for decades, your money needs to be in an Australian bank account for first.
Yeah.
So if you're putting it into a bucket account with a broker, then that's risk. And so we don't take that. So to me, I'd go with you. I'd be going with a CommSec or a big bank broker first and foremost, and sort of avoid some of those ones that are sort of that what do you call it? Those, not the GameStop, that was the stock, but
yes.
That Robinhood type stuff.
Yes.
They're just...
Well, we've said it, and we did a show on broker accounts. So it's probably a good show to go back and watch. But when the stocks aren't in your name, there are so many issues that can go on there. So
yeah, so make sure the stocks are in your name. You've got a CHESS holding, etc. Make sure your money's in a bank account, and then pick the best platform for you, depending on what your goal is. Now, remember to show your support for our channel and smash that like button. Do it right now. And if you enjoy watching, want to see loads more of our content, make sure you also click subscribe. The subscribing helps others find our channel, so we can help them too. Before we let you go, what was your favourite part of the show? Was it Phil's hot stock tip, or our topic for tonight, or was it even a viewer question? Let us know by commenting below this video on YouTube. Thanks to you, or thanks to all of those watching on YouTube and Facebook. And if you're watching on talkingwealth.com, stay tuned for more exciting stock picks, insights and strategies, because we'll be right back with all of that and more. Next week in our main topic, we're getting to passive income, how the wealthy get rich effortlessly. Make sure you join us next Tuesday night at 7 p.m. Australian Eastern Time. Now, if you love our show, remember to hit that like button right now and subscribe to our channel, as this shows your support for the team that puts in the effort each week into bringing it to you. If you are subscribed, then you'll always know when we go live and put up new content. As always, thank you for joining us. For now, goodbye, good luck and good trading.